Hello everyone, and thank you very much for coming along today for our first quarterly Q&A session of 2021. I can see more people popping in every moment. So today is purely about your questions. We have a few pre-submitted questions, and obviously do feel free to post any questions at all throughout the session as well, and we'll do our very best to answer those within the half an hour. We are going to finish at 4 o'clock, so we have half an hour today to get through those questions. If there's anything we don't have time to get to, we will of course come back to you afterwards by email. So Aubrey and Aziz will be answering your questions today, and we'll get started with our first question. Will we see fiat valuation change in future with cryptocurrencies becoming widely exchanged for goods or services?
Right. Hello, everyone, and welcome to the first quarter 2021 Q&A as well. I'm just saying that I'm trying to think through that question, I guess, as Sophie was reading it. And I think there are two ways to answer that question. There's a short answer and a long answer. And the short answer about whether fiat currencies will weaken against cryptocurrencies is, I don't know. And I doubt that anyone actually does know. But the way they would weaken or strengthen, one presumes, should be a function of two things, I guess, like any other asset out there. The first thing is it assumes that they continue to be used, or not continue to be actually, they become used in everyday life. And then the other thing is, like any other currency, what are the factors that are drive it? They usually are interest rates and inflation. The two are obviously intertwined with each other. And so as long as we don't know the answer to question 1 or question 2 around usage or around kind of inflationary pressures between any specific pair of currency versus another, whether that other currency is crypto or classic fiat currency, then I think that question is just not answerable. And Don, Aubrey, do you have anything to add there?
Yeah, I suppose just quickly, I'd say, look, this is really not our specialty. Bitcoin and FX is not our specialty. I don't know much about currencies, but I do know a few things about network effects and about businesses and about market share. And, I think to myself, look at Visa and MasterCard, look how entrenched they are with their network effect. Now, you think they're good? Let me tell you, currency has a network effect that is a whole lot better. Now, Aziz once asked me, would you like to get paid in dollars? Well, no, my mortgage is in sterling. I buy food in sterling. So in order for Bitcoin to take effect, you have to break the network effect that currency has. And I think that would be very, very difficult. But the second thing is, even if this does happen, what is the effect going to be on sterling on dollar? Well, I'm reminded of when I looked at Sage and Zero, and I once had a very negative view of Sage because Zero was going to take share. And I was going, hang on, but Zero has got 10% market share and it's growing at 30%. And his thing, it really just didn't touch Sage for such a long time. And I think it's something that people overlook, that these new disruptors, that have these, that are growing so fast, that look so shiny and so new. You imagine that they must have this effect on the incumbents really early on, and I think it takes an awful lot longer than you could possibly imagine for these things to actually happen. So, is something going to happen? Is Bitcoin going to have an effect on US dollar and sterling anytime soon? Famous last words, but I severely doubt it.
And I guess someone will jump and say, can't remember his name, but there's an American football player that just agreed to get paid in, I think it's Bitcoin, some crypto. And I'm reminded with the peak of the dot-com bubble, William Shatner was a spokesperson for Priceline, and they paid him with Priceline stock at the peak, and then a couple of years that became almost worthless. Granted, Priceline did eventually become Booking, and that did succeed. I don't think that I think with the benefit of hindsight, he would have preferred to have been paid in dollars. So I guess the point is as well to Aubrey's comment that not only does it take time, but even if many people in your mind, and many could be hundreds or thousands, adopt it, that path to adoption needs to get to really high numbers, like millions of people before, who like Aubrey said, get paid for it and use it and all of that before it can really become a serious contender to something that is incumbent.
Excellent. Thank you very much, guys. Moving on to our next question. From a value perspective, how does Mea's portfolio cater for blockchain and DeFi companies?
Right. Doesn't. I think there are 2 points that we've made in the past, which I think apply to any emergent technology. First one is it's pretty hard to know whether a new technology is going to succeed and in what time frame. And then even if you're right about a certain technology succeeding, then it's also extremely hard to figure out who, whether it's a company or group of people, whatever it is, are actually benefiting or going to benefit from. So even if we knew how these things were going to play out, and we definitely have no idea about that, because like Aubrey said, it's not our kind of circle of competence. But even if we did, I think it is also exceedingly difficult for us to also, at the same time, figure out which companies are going to benefit from it. So it's a space that we watch and learn about every day. And I think the reason we do is, A, I think it's interesting, but B, I think you never know in our industry what is it that's going to come and have an impact on some of your holdings or some of the companies that you're looking at. So you always have to watch and learn, but that doesn't mean that we're going to do anything with it in terms of our actual portfolio.
Thank you. Okay, next question. Tesla results yesterday were helped by a sale of Bitcoin. Is there a concern that in the new world, these disruptors are diversifying too far away from what they're disrupting?
Well, I'm sure Aubrey is going to have more to say about some of the specifics. I will say 2 things on that. One, I think in principle, I have a preference that companies stick to their knitting and focus on whether it's a disruptor or not, just any company, focus on their core business and not kind of fool around with other things on the side. And then the second thing that I want to say about it is surprisingly it's a surprising coincidence that the sale of the Bitcoin and the resulting gains that came from it happened to be in an amount that bridges the gap between Tesla missing street estimates and Tesla beating street estimates. I'm just saying it's a coincidence, but Aubrey, I'm sure you have more to say there.
Well, again, I'd reiterate what you said. It is an amazing coincidence because Elon Musk did specifically say that it was not to, he did not sell Bitcoin for profits, and they did not buy it so that they could book profits. It was just to explore alternative currencies that they could hold on their balance sheet. And he only sold it to test out whether there was actually enough liquidity. I mean,
to prove.
Yes, because I have to say, though, if you need to prove that there's liquidity, you really should not be making that sort of bigger bet beforehand. So it strikes me as some pretty lousy capital allocation. But no, look, here's the thing. He's not diversifying away from his core business operation. His core business operation is accounting misrepresentation. And this is just more more of the same.
Okay, thank you guys. Moving on, next question. What is a non-fungible token?
Right. So I will come out and say that I am definitely not an expert in this question, or for that matter, the string of questions to date so far in this call. But lack of expertise never prevented me from saying a thing or two about something. I think the way I think about non-fungible tokens is baseball cards, and this will may or may not make sense to you depending on your geography and age, or Pokemon cards if you're a bit younger. Basically, you collected items that different baseball cards were more or less available. So there's the supply of any specific card with a player on it is varied, and some cards are rarer than others, and people traded them, and the rarer it is, the rules of supply and demand meant that they became more expensive when you traded it. And so non-fungible tokens are the digital equivalent, in my mind, of baseball cards. So they are, one was a piece of paper with a picture and some numbers and text printed on it, that to me held no intrinsic value. But a lot of people nonetheless traded it and bid it and paid a lot of money for it for whatever, let's call it, utility they got out of it, even if it's just a piece of paper with a picture on it. And I think non-fungible tokens are just the digital equivalent of that. Again, I don't think they necessarily hold any intrinsic value in of themselves. And so the argument is that against them, that they hold no intrinsic value, I think is not a valid argument, because neither did baseball cards. So as long as some people want to trade them for utility, ego, happiness, whatever you want to call it, then they could exist the same way baseball cards and Pokemon cards exist and continue to. But that's kind of the only thing I can say about it. I don't know, Aubrey?
So someone described it to me as the difference between a print and a poster. That, a Cartier-Bresson photograph, the poster of a Cartier-Bresson photograph is worth £5. The print is worth 5,000, or probably a lot more now. There is some value people place, or there is a worth that people place on owning something, but it doesn't feel right to me. I think it's probably more a way of passing people with their money, but I'm probably too much of a cynic on this.
Okay, thanks, Aubrey. I'll move on to the next question. Just a reminder that if anyone does have any questions they'd like to pop into the chat, please do, and we will do our best to address everything in this session. So next pre-submitted question, you've added non-extractive industries to the list of restricted sectors, yet the new greener economy seems to require more copper. How do you reconcile those two?
Well, to me, the reason we added it isn't because anything has changed. We've never invested in extractive industries in the past, never will. My main issue with those industries, generally speaking, has been and continues to be around the governance and the way that they behave in many places in the world. So it's a behavior, in my mind, many of them, and by no means I'm saying all of them, but many of them behave in ways that I find unethical, whether it's how they get contracts in certain countries, how they continue the split and the economics of those contracts versus some of these countries that are in many cases are disadvantaged versus those extractive companies. And then finally, how they deal with the environmental impact once they leave. And regardless of the environmental impact itself, the ramification on communities from that latter part when they leave has always been an issue that bothered me a lot from a social/governance point of view. Now, the environmental impact also matters, I think, but in theory, and in some cases, I can see how you could end up with a company that can extract things in a way that is controlled environmentally and in a sensible way. I see how you can have contracts and governance in place where they are socially responsible. And I can see how you can have governance structures around it where issues of corruption and issues of conflicts of interest are addressed well. So I don't think it's impossible, but I do think that in general, historically, it's been an industry where there's just been a lot of bad actors. Now, so that's the one reason why we don't invest. The other reason that we don't like to invest is we don't like to invest in commodities as well. And so we prefer companies that sell goods and services where they add a lot of value, and that added value translates into higher returns on invested capital instead of capturing economic rent or earning their weighted average cost of capital otherwise, which you see a lot in a lot of these extractive industries. So that's kind of the investment side of why we don't do it and have never done it. I guess the second question is, what do you do when a lot of the solutions that are now proposed to things like the challenges of the climate and otherwise require a lot of materials? And I think it won't be perfect. I think I'm very pragmatic about it. I'm not naive enough to think that you can have everything perfectly, but I think we should, by we, I think humanity should try to find ways to get to that outcome while innovating on the technology side to do it in the most environmentally friendly way. But I understand that it's not going to be perfect anytime soon. But long term, I do think it's doable, especially the bits around social and governance. And I think the environment we can do a lot to improve on to get to those outcomes. And in the end, my position on a lot of these things, kind of that one could say are less responsible or irresponsible, depending on your view, not just in issues of mining, but in general, is I don't think they're going to go away, at least not anytime soon. But just because something exists doesn't mean that I have to make money off of it. So I understand that they're going to be there, but I still don't want to make money off of it as an investor. This is kind of how I reconcile the two in my mind. Aubrey?
I mean, I quite like Mark Twain's view on mines, that a mine is a hole in the ground with nothing at the bottom and a lyre at the top. I was once at a charity ball, and Frank Timmis, the CEO of African Minerals and various other AIM companies involved in extraction, asked me why I don't invest in mining, and I told him that exact reason, to which he got rather upset and just walked away. I turned to my stepfather, who was with me, and he was and said, John, look, I tell jokes about lawyers being lying scumbags all the time. John just said, yeah, but I know most lawyers are not actually lying scumbags. And actually, I've just Googled this guy, and he's now into Bitcoin mining. So I think I had it pegged pretty well. Yeah.
Okay, thank you. Last of our pre-submitted questions, and then we do have a couple of questions that have come through. Thank you very much. Is it possible for the asset management industry to successfully define or quantify ESG investing?
So this is a question that we get a lot, and a lot of allocators bring it up. And I think it's the same with trying to define anything about investing. You can define it and you can quantify it, but only to a degree. And I think it's unreasonable to expect that you can quantify everything to a dot, whether it's defining a quality of a business or what is intrinsic value of specifically of a company, or how you do it. I think all of us approach these questions in different ways, and that is the difference between different investors. And I think it will be the same with issues of responsibility and ESG. You want to have some kind of clear and transparent metrics and kind of guardrails around it, but you should expect that there are going to be different approaches and different opinions. And I do think that trying to think that everything needs to fit into a box or is a black and white is just completely unreasonable. There's a lot of gray there, and there are going to be differences of opinion, and it's part of our job to do that. And just like making investment mistakes and valuation mistakes, I'm sure we will make and have made in the past mistakes around issues of responsibility and ESG. It's just part of what we do. We have to learn from them and get better the next time. But I don't think we're going to get to a point. If it was something you can program, then I think a program can do it. But I think people are just too eager to try to simplify things into very simple metrics, and then, I don't know, probably build a passive index around them is just what they want to do. And I think a lot of things are just, things should be as simple as they can, but not simpler. I think as Einstein said something along those lines. I may have butchered the quote. Aubrey?
I think the important thing is transparency. Look, Aziz and myself will differ on small elements of what ESG means to each of us. The important thing is to say, look, this is what we believe, this is what we're going to do for the fund. And Aziz says, okay, this is the thing. And then we're transparent with investors and say, these are our principles. And it's then for investors to decide. And if every fund says, look, these are the principles by which we invest in, these are the ESG principles which we have, the market will then decide. And some people will agree with us, some people will agree with someone else and find that another fund is more suited to them. And the market sorts it out.
Yeah, I think, and to Aubrey's point, and I'm going to take it to a silly extreme, but if we came out ahead of time, I think it doesn't work after the fact, but if we came ahead of time and we said, we're going to launch this new strategy where we will not invest in any company whose name starts with the letter M, and people still invested with us, and we had no good reason to do that, but we still came out and it fully been transparent that we're not going to invest in any company that starts with the letter M, then I think it's fair. As long as people come in knowing that, then it doesn't matter. And so when you have things that are gray, obviously, and this is just a silly extreme example, I do think that there just be transparent, and some people will disagree, some people will agree, and those who agree will become investors, and those who don't will find another fund.
Okay, excellent, thank you. Okay, so over to a live question. Do you see inflation coming into the system? We've been hearing this quite often these days. How is the portfolio positioned, and what could be the potential impact of this event on the portfolio?
I mean, this is definitely. Aubrey, did you want to jump in?
I was just going to say, a friend of mine actually asked me this the other day, and he's one of these friends that always asks the sort of latest trend. So it's usually a good idea to do what he doesn't do, at least historically, up until recently, when things like GameStop, Bitcoin, and all these other things, he's got completely right so far. Now, I think a lot of people are talking about it now, but I don't think the conditions are really there to see it happening on the labour. There are shortages, there are chip shortages, we're seeing that, but the labour market is not yet tight enough that we should actually start really worrying about it. Now, that could all change very, very quickly, but I think when you see isolated pocket examples, such as semiconductors, it's then not such a worry. It's only if you see it in the labour market or agriculture. That is the other place where inflation can all of a sudden become very worrying. And we're not seeing that at the moment. But on the other hand, look, if you believe in inflation, equities, whilst they might, have a very rough ride, they're the only place you really want to be. Maybe gold, but we have philosophical views on gold. So, sorry, back to you, Aziz.
I'm just mindful of the time, and I do see quite a few questions coming in. I'll try to answer as many of them as possible. But yeah, I think the one thing about inflation that people often seem to find necessary but insufficient conditions for inflation, such as monetary expansion, and say, here, see this, there's got to be inflation. I think there's a difference between something that's necessary and something that is, you've got the conditions for it, but it doesn't mean that you don't have all of the sufficient conditions for it. And so that's the thing. And like Aubrey said, I think it's, if you do have inflation, and by inflation I mean really high inflation, then of the options on the table today, equities are the least worst asset class to be in. So if you want to give us the next, let's do the next two questions, just in the interest of time.
Yes, absolutely. I'm conscious of time. So are there any new positions the portfolio has added during the last quarter? And if you can explain your reasons and theses for these.
Yeah, so we talked about this in briefly in the letter. So I'd point you to our recorded letter, which is available on the website. But we did build a position in the shares of Danone, French dairy company. And I guess the reason and thesis, Aubrey, do you want to kind of in a minute give us the elevator pitch there?
Elevator pitch on Danone. Okay, so basically you've got a high quality consumer goods business that has spent too much time focusing on ESG. Now, whilst we obviously applaud ESG, it should not be to the exclusion of all else. And you have an activist who has come in, shaken things up, and the result is this good business should now be able to shine and deliver profits. If that doesn't happen, it's still trading at a discount to what we believe fair value is. So it's a sort of heads we win a lot, tails, we may not lose much, if anything.
Yeah, and I want to add that it's not purely that they were, their mistake wasn't just the ESG part. I think it was just the run below where it should be run. So it's, I won't say mismanaged, but not managed as well as it could be on many sides. So there is some kind of room for operational improvement, and certainly under new leadership, I think the chance of that happening is higher than under old leadership.
Thank you. Okay, I'll move on quickly. We have two questions and really just a couple of minutes left, so let's see if we can get through these. In late 2019,
if you can ask both of them at the same time.
Yeah, absolutely. In late 2019, Mayor announced that it was going to be redomiciled to Ireland. What's the latest on this? And how have the funds flowed into the fund during the last quarter, and what is the AUM?
Okay, so on the AUM question, yes, we continue to get money from existing and new investors. As of today, we have 235 million or so, $235 million of assets under management and the out capital. About half of it is in the fund and half of it is in managed accounts. Though we expect more and more of the coming inflows of the rest of the year to come into the fund actually. And the other question on the redomiciling the fund, we have restarted the process a couple of months ago. We actually have made the first and second steps in terms of filings with the Central Bank of Ireland, which is the regulator. We still don't have an exact time, and it's very hard or impossible to come up with an exact time for something like this to finish. But we are very optimistic, let's just say, that we can get it done before the end of the summer. And barring any surprises, that should be the case. But I don't see any reason why it would drag much longer than into the fall in a worst case scenario.
Excellent. Thank you, Aziz. And thank you very much, everyone, for attending today and for your questions. As always, if ever you would like to reach out to us, please do. And we'll be back next quarter with another Q&A. Thank you very much.